But let's analyze the policy nitty-gritties and dissect that in further detail. We've got Nilesh Shah from Kotak AMC joining in on the show. And we also have Mr. R. Gandhi on the show with us. Gentlemen, morning to both of you. Mr. Gandhi, let me first come to you. What to your mind actually stood out from the governor's commentary, given that it was along expected lines and a status quo?
Yeah, that's right. In the whole policy announcements were are on expected lines only, both by the market and others going by any standards. I don't think anybody would have thought otherwise. Of course, going forward, everybody would be expecting the rate cut to come in sometime soon. So it could be in August or October. That will be the next debate. That would obviously depend upon the inflation footprints that we will get this month and next month. So that should guide us. But the point Governor has mentioned very clearly is that food inflation still could be playing round. So that is where we need to be watching. And other announcements, which are all for increasing the safety and soundness of the banking system and the payments and I think that is welcome.
Sure. Before I go to Radhika as well as Nilesh, just one more question to you, Mr. Gandhi. You talked about, yes, the governor not increasing the inflation estimate, even though he increased the GDP estimate for FY25. But he did talk about two, specific issue. One was that it was a word of caution to the NBFCs as such, because they talked about the entities charging fees for small value loans. So that's something to watch out for, because a lot of microfinance companies and the NBFCs will be in focus on account of that. And secondly, there was a word regarding the credit deposit growth rate, which warrants a rethink as per the RBI. How important these two statements were, Mr. Gandhi, for you?
Of course, consumer protection has been in the RBI has been paying more attention on that in recent months. Especially the disclosure relating to the terms and conditions of the most important terms and conditions of the credit that is being offered by the credit institutions. And that is the first step which had already taken. Now, next step will be where the banks and the other institutions where they are not transparent enough. And if they are crossing certain limits, then regulatory action should be following. That's the caution which Governor has implied when he said like that. So that is again, as he said, consumer protectionism is definitely within the ambit or the mandate of the Reserve Bank of India, and it has started paying more close attention on that, especially at the lower end, because at the lower end, the small value loans, if the rates are more, then it is definitely it is affecting the bottom of the credit institution, especially microfinance and all. So that's why the caution has come in time. The second question that you asked relating to credit deposit ratio, yes, that is because for the past 2 years, deposit growth has been a little tardy in the banking system, whereas credit growth has been much higher compared to the previous years. So that the narrowing the gap between credit growth and deposit growth. So that in that process, the banks typically have kind of increased their incremental credit deposit ratio. That is not good in long term for the safety of the robustness of the balance sheet of the banks. So that is where I would think that, because of course SLR is only 18%, but the HQLA requirement definitely requires the banks to have additional portfolio in terms of investment in high quality securities like government bonds and others. So that would automatically mean that their advances should be at a moderated level. That's what is indirect caution. That's my quick read.
Nilesh, I know the market's mindshare perhaps is more right now on who's going to get which portfolio and ministry. But from the governor's speech, anything that the markets can derive?
RBI is in a perfect position. Growth is in the higher range. Core inflation is well below RBI's midpoint range of inflation. Trajectory of inflation is downward. Rupee is stable. Banking NPAs are under control. Liquidity is finely balanced. So frankly speaking, RBI is in such a good position that all market want is just continue this form. you don't have to do anything else but to maintain this dream position. And obviously, market's priority today is more on the formulation of policies by the government, which will be known once the portfolios are allocated. So what is going good, why repair it, which isn't broken.
Okay, fair enough. Radhika, hi. Let me come to you and get in your take. Any key takeaways from what was announced by the RBI governor and that particular focus on remaining vigilant on the upside risk to inflation?
Hi, good afternoon. I think the markets, including all the observers, went into this meeting expecting nothing very different. But in fact, we were surprised on a couple of fronts. The first one being that there is one more committee member who has joined. So there's a 4-2 split now in the policy committee rather than 5-1 that you had seen the last couple of rounds. That means one more member is on the relatively dovish side of the spectrum. And then you've also, the second surprise came in terms of upgrade in the growth forecast. RBI has done about a 20 basis points revision, and if you see the quarterly breakdown, it's actually revised up all the quarters, most notably the second one, but across the board there's a 20-30 basis point shift in the trajectory. And the third one would generally be, there were some in the market thinking that October could be a time, or a second quarter could be a time when RBI could look to change its stance or to begin to consider rate cuts. But I think that also they answered by saying that there is a sharp correction in inflation coming, but that's temporary, that's base effects driven, and they will not be guided by that. So I think on these three fronts is something that makes it different from the previous commentary. But apart from that, I think their positive view on growth, cautiousness on inflation, bias towards keeping stability in the financial sector. We should remember that not specifically to the policy review, but apart from that, they've been taking a lot of regulatory and macroprudential measures, timely and prudent, because if they've spotted any issues with the entities or with the particular segments, they've gone ahead to act. So they are taking action where necessary, but on an overall policy review perspective, I think there is very little reason to believe that they need to be less restrictive. European Central Bank cut rates overnight, and they use the term reason to be less restrictive on policy. I don't think even that holds for RBI. So there is no reason to provide any stimulus at this stage. So it's quite a steady ship insofar as the policy is concerned.
Radhika, what you're saying is don't expect a rate cut this year, right?
Yes, our baseline, which has been held on for the past few months, and I continue to hold on to it, it's that a rate cut is unlikely this year. Fed, there is a fair amount of confusion or uncertainty on if they will cut and how much they will cut by. But I don't think that's going to be a major guiding factor for RBI. I think it's domestic considerations, and they have mentioned it time and again. From that perspective, and of course, prompting to provide stability to the financial sector overall, I don't think they're going to start lowering rates or changing their stance in a hurry. So yes, our baseline assumption is that they're not going to cut this year.
Right. Okay. In fact, some more commentary coming in now that we've got the press release as well from the RBI. The governor on US Federal Reserve decision saying while we keep an eye, we play the game according to the local pitch conditions. And of course, we've got a fellow cricket fan, Nilesh, as well here. But Nilesh, cricket analogy aside, I guess the market is pretty hung up right now on figuring out whether or not the government now in its new avatar is going to have a more populist flavor or not. We were hoping to hear something about rural recovery from the RBI governor. But what's the market's reading so far?
So undoubtedly, equity market, if we look at the FMCG stocks, are believing that there will be some consumption boost out of the RBI dividend. And that's where we have seen consumer stock going up. There are also two other factors which is driving FMCG stock. One, expectation of good monsoon and benefit to rural and agriculture economy. Second, generally, around election time, there's a lot of money which changes hand, and that should also support consumption at the bottom end of the pyramid. So market is pricing in sustained recovery in consumer. And even when we talk to some of the media companies, they did show that there is interest in buying media ahead of festival season by consumer companies. So All these things are coming together to give confidence that maybe there is consumption revival at the rural, at the bottom end of pyramid, and in mass market product.
Let's welcome on board Kaustubh Gupta as well, who is joining in. Kaustubh, just to take off from what Nilesh Shah was talking about with respect to the confidence returning when it comes to consumption, in particular when it comes to the rural areas, is that something that will be the focal point now? And are you seeing a revival kicking in?
Look, with the change in the new political landscape, of course, we think that the thrust for the new government will be towards a rural focus, and which is why we do think that incremental policy stimulus will be more towards more balanced growth, specifically focusing towards consumption side of the economy.
Okay, point taken. Let me just quickly go to Mr. Gandhi as well. He's been waiting by. Mr. Gandhi, were you actually surprised by the revision upwards in the GDP estimates? Because given the last quarter numbers, which were completely blockbuster, wasn't it factored in that there would be a trickle in effect in Q1 and henceforth from here on as well?
Yeah, that's what assumption right now we have to make. Of course, by month end, we'll get the full data from NSO. Until that time, we have to believe that what you said, that a uptick is going to be across the board and throughout the year, not just one quarter flip and nothing. So that way, it is going to be wholesome throughout the year. Yeah.
I wanted to flag out a few more stocks and see what the reaction is. For instance, Paytm has seen a bit of a spike in the last few minutes. Five-star business is also actually holding up 7% higher, though the comment that the governor made didn't sound as much positive about the NBFCs and the microfinanciers, because it was all about how some of these NBFCs are charging high interest rates and fees which is not properly disclosed in the term sheet. So that was something that the entire sector will watch out for. And of course, with respect to the deposit credit mismatch as well, again, Bank Nifty and the banks will be in focus, because that was the worry that there might be some sort of regulation or check on the CDR bit. Hadn't really fructified, but that is something definitely that the RBI is watching for. But for now, the banking names and the microfinances are actually holding up in the green. So let's see which way it goes. But Kaustubh, coming back to the point, in terms of the 10-year yields as well, we had seen a massive move of late since the time of elections itself. What's your own expectations as to where it's headed? And overall, what do you think is the outlook for the fixed income portfolio as well?
Look, for now, bond markets, they are more awaiting for the clarity on the path for fiscal consolidation, if there is any change on that path or not. As we discussed a while back, that incremental thrust should come back. The mandate is towards a rural economy. The base case for the market is that fiscal consolidation path, which government has envisaged for next 2 years, they will stick to it. And if government sticks to it, we do think that the overall bond yields and especially fixed income portfolios should do well. Our base case is that once we have clarity on that count, we could see yields easing between 15 to 25 basis points over the course of next 6 months.
Nilesh, for BFSI at large, is there reason to worry, and should the market read too much into the governor's statement? I mean, talking about that, they've already observed that interest rates on few small value loans are high, the fact that they are already spelling out that they are engaging with regulated entities on the observation, because we all know how some of these, regulatory clampdowns, if I can use that terminology, has been very damaging for the stocks.
So, when you want to play game of bowling, you need guardrail. And it does stop your ball going into other lanes. Regulatory supervision is the guardrail. If you want to play the game, guardrails are necessary. In my opinion, RBI is formulating rules, regulations, keeping in mind what is probably happening at the lowest common denominator. I don't think so. Entire banking and NBFC sector is defrauding their customers or charging them higher without letting them know. So to me, probably majority of banks and financial services sector will have no impact of this regulation. There will be some bad apples in the apple cart, which will have to fall in line. I think one very important thing which is necessary is to create level playing field. There are people who follow the law in letter and spirit, and there are people who keep on taking shortcuts. And which is why this guardrail is so important, so that everyone plays in the same lane.
Okay. Nilesh, we're just wondering what exactly we missed that one word, game off, that you were referring to.
The bowling alley, where the guardrails are there.
Yes. The bowling. Yeah.
Got it.
No, it's from cricket now.
Yeah, exactly.
Time to
It's
diversify.
so hot. You've got to be in an AC environment. And yeah, bowling, I guess, is better a choice.
Okay, but just to move forward away from sports to credit policy, and Kaustubh, just wanted to understand from your perspective in terms of these geopolitical risks and how we're seeing crude oil faring, etc. How much of a concern will that be for us?
Subsided. Yeah. So of late, these risks have subsided quite a lot, and markets are taking clue. If you see in terms of commodity prices and in terms of geopolitical news. But one thing is for sure that the US hegemony, which was available to the world for last 30, 40 years, that has been challenged now. So we keep on getting these kind of frictions at now time and again, which means that general risk premium on account of geopolitics need to be factored in while making any kind of asset allocation.
Point taken. Radhika, just coming back to the question on the fiscal consolidation as well, right? Kaustubh talked about how it's an important factor everybody is watching out for. What's your base case scenario? Do you think they'll be strictly on the path that they've set out, or there is a bit of a possibility that they might just turn a bit more populist?
Before the election, there was quite a surfeit of revenues, right? So you heard about the RBI surplus transfer. We also heard very good GST collections, tax, non-tax both doing very well. So I think the discussion more was on the front of, are they going to retain the 5.1% of GDP FY25 fiscal deficit target, or are they going to improve on it, which is set it out at 4.8, thereabouts, because of additional buffer at this point. My take is generally that, if you've seen the past few budgets by the government, it's tended to be on the conservative side of things, to mean that even if they have the buffer, even if there's room to, cut back on borrowings, they've actually preferred to stay cautious and conservative. From that point of view, I would think that they will still retain a 5.1% deficit target, which keeps them on the path to consolidation, but not very aggressively. And given the point that there could be some demand-led stimulus which would make its way, either in the budget or apart from it, there is a high probably something towards urban poor, something towards the agricultural sector. So they will keep room for that as well. So instead of going in the other direction, which is to widen the deficit, I think they would probably adapt a more modest approach, a modest, correction in the fiscal deficit target. So we would think that if your 5.1 still looks very feasible. And of course, rating agencies have been moving very slowly in recognizing the improvements that have been ongoing. Finally, you had the S&P, which had gone ahead and changed the outlook. And I think if this remains on track, coupled with the fact that overall debt to GDP levels would begin to also show movement in the right direction, I think that should pacify the agencies and more. But that apart, of course, that's not a very big driving factor. I think driving factor is for the government to make sure that they get towards that 4.5%, which I think is very much on track, notwithstanding the recent surprises on the politics front.
Thanks so much, Radhika and gentlemen, for taking time out and joining in with your extensive insights on the monetary policy action. We'll wrap it up with news that we're at 23,041 on the index. Thanks so much for watching.
If you like this video, then like, share and subscribe to ET Now.